Hello and welcome to our special holiday investing show. I'm Peter Switzer and I want to get you ready for investing in 2021. Now in mid-December, Berman Invest Julia Lee and Tribeca Investment Partners Jun Bei Liu looked at stocks on their radar screen. There are ones also that I was pretty interested in as well. Their revelations gave some interesting ideas for investing next year and I really did want to share it with you. Then I'd like to share with you an interview I did with JB Hi-Fi's Richard Murray. Now Richard is one of the prime reasons why I like this company. This company has done very, very well and every time it sells off, it's a company I want to buy. Sometimes the stock market sells off because they're buying other stuff. There's nothing wrong with this company and JB Hi-Fi is a top-notch operation and I think you should have a good look at the calibre of the guy who leads it, Richard Murray. Very impressive guy. Well, as per usual, catching up with Julia Lee at a time when the market had a pretty good day. I think the SPY futures suggested we'd be down, but we've headed up. Julia.
Yeah, the Australian share markets had a good day, mostly because US futures have been up about 0.5 to 0.6% during the session. And in particular, we saw technology stocks do well. Afterpay surged. It's going to be included in both the ASX 20 and the ASX 50 index for the first time from the 21st of December. So no doubt any short sellers would be closing out positions, which would help to boost the price there. But outside of that, the banks were very strong. Banks were up around about 1%. And then we saw it being the Christmas trading session, retailers in focus. Wesfarmers reached a record high. And we saw both the consumer staples as well as consumer discretionary sectors doing well. Unsurprising given the strength that we've seen in consumer confidence, as well as the strength of household balance sheets post-COVID-19, given all the stimulus that we've seen.
Did you say you were surprised to see that consumer confidence so strong?
Yeah, I think consumer confidence, I think I've been surprised at how quickly it's all bounced back. We've seen housing prices as well on the move up, and that's helped to feed into confidence. And of course, we haven't been able to spend on things like holidays. So I guess that's sort of gone a little bit into retail, but a lot of it's gone into savings as well.
Julia, you're going to start reading me every morning. I've been tipping this for about 3 or 4 months. Now, come on, switzer.com.au, read that first and then go into all your fantastic company analysis.
All right. I read it, Switzer.
I know you do. Anyway, let's go to a company that got a bit of a clobbering last week. And I think over the many years you and I have chatted, Appen's been a company you've liked in the past. What do you think's going on there now? And is it the buying opportunity for someone who's a buy and hold type of person?
Well, Pete, you obviously know I like Appen, so I thought today, instead of giving my opinion, I thought I'd read some of the broker commentary coming through after that downgrade. So starting off with Macquarie, they have an outperform on Appen. They said that the downgrade was largely backward-looking and the positive outlook justifies the continuing outperform rating. Citi also has a buy. They've retained their buy on the firm's potential to benefit from increased spending in artificial intelligence. They don't think that the recent lower demand points to a loss in market share. And then JP Morgan also has an outperform. They said that Appen's guidance downgrade is just a short-term blip and the AI firm's shares appear oversold, so looking relatively cheap. And I guess the thing about machine learning is that this area is expected to grow by 36% compound annual growth over the next 5 years. So if Appen only grows with the market, that's very strong rates of growth that we're looking at. So, you know, with these type of downgrades, I always ask, is it forever or is it a once-off? And Appen did say that because of COVID-19, the tech giants were a little bit slow in new projects. So hopefully next year, as those new projects build, we will see Appen's demand building as well.
Yep, and Silicon Valley is in California and they're locking the place down at the moment, aren't they?
Yeah, at the moment. So definitely going to be a post-vaccine story, but I think this would probably be the cheapest you'd be able to get in on Appen in a number of years.
Yep. Now Xero, and I've been informed by someone who's pretty intelligent who believes that this share price we're seeing now, which is shocking all of us, He thinks it's going to go a lot higher over the next 3, 4, 5 years. 3 or 4, 5 years, I'm saying. What's your view on Xero?
Well, Xero reached an all-time record high on the market today. And look, I think the best part of Xero is really the Australia and New Zealand business. I use Xero, and what I like is that the accountants all know how to use it. When you get an invoice, it feeds directly into the system because it's used so broadly in Australia and New Zealand. And I call this the network effect. But with the multiples that Xero's on at the moment, I don't think it's enough to get growth from Australia and New Zealand. What the market's really pricing in and what you're paying a premium now for is growth from international markets, in particular the US market, which is huge, as well as the UK market. And looking at the US market, you have much bigger competitors there like Intuit with much deeper pockets as well. And one of the lovely things about Xero here is that network effect. When you get an invoice, being able to put it directly into Xero because everybody else is using Xero or MYOB, whereas in the US, you don't have that network effect. So I think it's going to be a much harder slog. So look, probably neutral on Xero. I do like the Australian New Zealand business, but there's only so much you can grow in terms of hiking up fees to help boost revenue. User growth will probably bounce back next year post-COVID-19, but it's really the US and the UK that you're paying for. And I think that's a much harder slog there to get growth. So I'm probably neutral here, especially given the valuations you're seeing.
Okay, let's go to PushPay next.
PushPay, look, I think that companies, when they're very much in favor, you hit a bit of a sweet spot, and there's easy profits or easy pickings in terms of profitability. And I think PushPay has reached saturation in that those large, massive churches over in the US. So they've pretty much dominated that area. For anyone that's unfamiliar with PushPay, it's basically being able to make digital payments when you go to church. And those mega churches have meant that PushPay has been able to grow quite rapidly. Now they've pretty much saturated that market. They're going to have to move on to smaller churches. So even if they move on to large and medium-sized churches, it's still going to be difficult to grow at the level they were when they were signing on these mega churches. So I'd actually steer clear of PushPay for the time being.
What about Nuix, a big float last week or the week before? Do you like this company going forward, Julie?
Look, I'm a fan of both Appen and Nuix, and I do like companies that are leaders in their area where it's very difficult to duplicate the business model. With Appen, in terms of artificial intelligence and the area they're in, there's only really two key firms in that area. And look, they need to hire millions of people to service those huge tech giants like Facebook and Google and Alphabet. With Nuix, it's a software and it's in the area of intelligence. So whether you're looking at customs or police, federal police, whether you're looking at ASIC, just trying to use data in order to pinpoint, I guess, things like financial fraud, payments that are going overseas, which might be illegal, and the big four accounting firms use it as well. So look, you're probably looking at growth of more 10 to 20% for this company rather than Appen, where I'd expect more 30% growth rates. But having said that, you know, it is a leader in its area. Very unusual to get a company of this quality on the Australian share market. The price is quite volatile at the moment, so I'd look to pick it up more around the $8 mark if I could, given that it does bounce around quite a bit.
Okay, you've talked about loving leaders in an industry. Zip is number 2. What's your view on Zip?
Yeah, I prefer to go with the leader or something really cheap, so one or the other. And Zip is neither. Look, I think Zip is looking cheap at the moment compared to the other buy now, pay later providers because the market's speculating that it's going to probably have to do a capital raising. And that's as it's targeting the US market, which has become a lot more competitive. So it'll need to spend more money in order to grow in that market. I think until it does that capital raising, you will see that discount being applied to the shares. So look, I probably, if I was interested in this one, I would get in straight after the capital raising when they've funded a lot of that initial growth into the US, but I'd prefer to be on something like Afterpay, or if you're looking for something relatively cheap, on Hum at the moment, rather than Zip, where the market is speculating that they'll probably have to do a capital raising.
Okay, while I'm on there, I did mention earlier this year, or talk about my ZEET stocks, and Tyro was the T in the ZEET. What do you think of Tyro at the moment?
I like Tyro. Look, I think the big four banks, they're quite slow in terms of innovation because of the way the culture is, as well as legacy systems. It's a lot more difficult for the big four banks to be nimble. And in the area of merchant services, Tyro is quite reliable. It's very nimble. And I think there is an advantage in being a smaller company. So you are looking at EPOS payments with retail stores opening back up again. I think Tyro's in a good spot, and I think it'll do well in 2021. So obviously playing that retail recovery story. And I think retail is going to be very strong this Christmas season.
Okay, BWX.
Skincare.
Yeah.
I use a lot of the products. They also own the Nourished Life website where you can buy skincare products if you're looking for a Christmas present for the man or lady in your life.
See, you are pushing us.
Basically, they're looking to be a one-shop stop for natural skincare. So they own Suican, Andalou, as well as Mineral Fusion. So if you're looking for natural skincare, which is a growth area, especially in terms of the US and Europe, I think it's in the sweet spot, especially at the price it's at the moment. So we have seen a bit of a pullback in terms of the share price. So I would be happy picking it up here.
And finally, Northern Minerals.
Yes, Northern Minerals. Well, you know, I'm a lover of rare earths. We own Lynas in the portfolio. Lynas is the largest producer of scale outside of China. And you could say Northern Minerals is Australia's second producer of rare earths. However, you know, their Browns Range project, you could really only classify it, I think, as a pilot project, not a full-scale production. So they are aiming towards that. I prefer Lynas. I prefer production, but look, prices are going in the right direction. And as long as rare earth prices are moving up, then this share price should also be moving higher. One of the things that I do drill into when I look at investments is I do look at the shareholder register. And look, there aren't any huge institutions on this list. A lot of them are individuals. It seems to be dominated by either Chinese companies or people of Chinese heritage, which isn't a problem. You just want to see a bit of a mix in there, usually with the major shareholder lists, hopefully a few institutions backing the company and a bit of a mix, but there isn't a huge mix there. So just looking to see whether they can get some of the institutions on board, and that would be a positive move. But otherwise, moving in terms of its results with its results in terms of the mines it's looking to produce that, as well as the rare earths price, I'd prefer Lynas at this stage.
All right, Julia, as always, thanks for joining us.
Thanks, Pete.
Hi, I'm Peter Switzer, founder of the Switzer Report. And if you're looking to build your wealth, my Switzer Report has everything you need. And so I'm inviting you to come and invest in stocks with me. At the Switzer Report, we provide you with expert guidance and actionable advice for managing and growing your wealth from some of the brightest stock pickers and investing minds in the country. And so I've got some great news. For the next 2 months, we have a fantastic Christmas and New Year offer that I would like to tell you about. If you take up a Switzer Report subscription across the months of December and January, not only will you get all the usual inclusions to the report, but you also will get the following. Exclusive one-off webinar with myself and Paul Rickard, where we will show you the hot stocks we picked in 2020, and we'll also give you the stocks we are picking for 2021. You'll receive a free copy of my book, Join the Rich Club, valued at $24.95. And you'll also receive a free ebook with our best investment ideas for 2021. Sign up today and receive 3 newsletters each week delivered direct to your inbox on Mondays, Thursdays and Saturdays, with analysis from our experts including myself, Paul Rickard, Tony Featherston and James Dunn, and others such as Julia Lee, Jun Bei Liu and Rudy Philippek Van Dyke. Your questions can be answered in the Q&A forum, where you can submit an investing question and receive a guaranteed response from Paul Rickard. Monthly webinars with myself and Paul Rickard, and special guests who will answer your questions live. You receive complimentary tickets to our events for you and a guest, including our annual Switzer Income Conference, the Switzer Investment Strategy Day, the Switzer Listed Investment Conference, and the Switzer Small and Micro Cap Investor Day. You'll also have access to our weekly Boom Doom Zoom interactive TV webinar, which are stock assessing sessions between Paul, myself and subscribers. You'll be able to view our income and growth model portfolios designed and updated each month by Paul Rickard, and you can browse the archives containing thousands of archives and resources about specific shares, the markets, SMSFs and more. Information and insights from people who live and breathe stocks 24/7 increases your chances of making some real money on the market. I really want to share with you all the insights I get access to that most investors are never lucky enough to see or hear. Come invest with me using my Switzer report. Follow the link in the description of this episode or visit www.switzerreport.com.au to sign up for your Christmas New Year offer and join me on the journey of financial knowledge and wealth, where I will be able to call you one of my valued Switzer Report subscribers. Well, we're catching up with Jun Bei Liu from Tribeca Investment Partners, and she's a portfolio manager for the Alpha Plus Fund, which she whispered to me when I made a mistake when I did my intro earlier. How are you?
I am very good. Good to be here, Peter.
Same here. Last show of the year for you. And I'm really happy to be running through some interesting stocks. And these come from a lot of the inquiries we get when we do the Boom, Doom and Zoom show for our Switzer Report subscribers. Let's start with a company that really reported in an ordinary fashion last week, and the market gave it a bit of a kick in the pants. But I like the company generally, Appen. What do you think is going on there?
Look, we like Appen. It's AI, exposed to that all that AI spend and all of that. But look, what's happening at the moment is that it has benefited a lot just during the COVID lockdown. There was a lot of spend across all these search terms with the large guys. But the problem with exposed to all these large clients like Google and Facebook and Microsoft,
Silicon Valley clients,
that's right. Silicon Valley client is that you just need one of them to spend a little bit less, and suddenly your earnings visibility becomes very poor, because ultimately it is a contractor for that whole cloud AI sort of space. So so the client's spending a little bit less, and so that has caused a bit of a downgrade for the earnings. And of course, because its earnings majority exposed to offshore, so US dollar exposed, so without currency helping them in the last 12 months, it is going to put a bit of a hit to earnings. Now, I think the long-term story is intact. So now short-term, there's a bit of a issue because people will build a bit of a story about whether the earnings growth is real and the like they always do with every downgrade for every company out there. So in the next 6 months, share price probably not going anywhere. But I think when it hit closer to that $25 mark, you do want to look into this business. It's one of the few pure AI exposure here in Australia. And I think the long-term story is still intact. There's a few question marks, but of course, in the short term, it's just being oversold.
Yeah. Do they have a competitive advantage over rivals out there? The fact that they're an Australian firm doing so well with Silicon Valley, it makes you think that their product is actually quite distinctive.
Oh, absolutely. Look, without the competitive advantage, they won't get those big clients, and the big clients keep allocating more and more money towards them as well. So of course, the margin is going to not going to continue to grow simply because they're getting a lot of volume. There are a lot of search terms because relevance is one of their bigger business. And so on these fronts, it certainly means the revenue is going to grow significantly, margin is going to be flattish, but still that's a good growth outlook for this business.
Being heavily exposed to California, with California going into lockdown with all their second wave infections, is there a bit of that in this as well?
Yeah, so part of the downgrade is due to because of the lockdown that's been impacting their earnings. It's harder for them to sell and get more income. But it is going to be a short-term impact, and in 12-month time, things will recover to normal.
Okay, I'm not going to tell you who told me this, but he's a really smart guy. And he thinks Xero is going to be a really big company with a really big share price down the track. Do you think that's believable?
Absolutely. I like Xero a lot, and I always regret whenever I take profit and in the company. It's done incredibly well, and it's every now and then people think we should be tactical, because recently share price rallied so hard against the rest of tech because it was included in the MSCI index, and that was a lot of buying volume.
The MSCI index.
That's right.
Explain it. We've got normal people watching this.
Of course, yeah.
What is the MSCI index?
Essentially, that's the global index for a lot of stocks, and there's a lot of buying.
She's an industry person. It's the MCSI.
MCSI, that's right. So those global index, whenever they include a stock, there's a lot of passive managers will have to go out and buy those stocks.
They track that index.
Exactly. And Xero, being a small, it's a large company, but in a global sense, it's a small company and doesn't have that many shares on issue. So the fund managers need to buy a lot of it to as they go inside that index. So share price outperformed the rest of the tech in the last month or so, and it continued to go higher even after that inclusion. So many of us.
Why was it included?
Well, it was included 2 weeks ago.
But why?
Why? Because it got to a big size, and there's just enough liquidity for this company, so enough trading for this company to be a global business, really, to list on that front. So many of us thought we'd take some profit because of that, but you know what? It keeps going higher. So I do think it's a global business. It's demonstrated its ability to grow in the UK, to replicate Aussie and New Zealand business model in the UK. Very strong data, and the US is the next big thing. I'm a true believer of this stock.
Okay. Pushpay. A lot of people like it, but it seems you're having a bit of a struggle at the moment. And you're a Pushpay fan too, aren't you?
Oh, I'm more of an Afterpay fan.
Okay, okay, you're not.
So I like a lot of those payment systems, but Pushpay has done very well during the COVID period. Of course, they went to the US and then they gained a lot of share across that payment across that church and charitable space.
So basically, it works in the church space, and we know Americans have a lot of very fanatical Christians who do often they do pay 10%, they tithe.
Yeah, that's right.
And during the coronavirus, a lot of people, because they weren't turning up to church, basically did it
they
online.
Were paying. That's right. So it's a true beneficiary of that front, but it was gaining a lot of share as well during that period. So company did really well until a few months ago when the founder or the family sold down quite a lot of shares. So sort of reduced a lot of demand for that stock, and ever since then, it struggled a little bit. That we've seen this often, for a small stock, and suddenly there's a lot of share that's being sold into the market. It takes some time to digest. Look, I think it's doing well, but right now it's just being perceived as a COVID beneficiary, and what market wants to buy is the COVID, the next leg of growth, which is the company that's being impacted by COVID.
It's interesting you should say that because we've got going on in our market right now. You've got the old stay-at-home stocks or the new stay-at-home stocks that did very well during coronavirus, and we're moving into the reopening trade stocks, and now they're doing well. And I made the point a couple of weeks ago that some of those really good companies like JB Hi-Fi, who might be sold by fund managers to get their money, to take their profit, to buy the reopening trade stock, will eventually be liked again. I noticed today JB Hi-Fi
up
is
significantly.
Up.
That's right. Yeah, I think you're absolutely right. In anyone's portfolio, it's about buying a bit of everything. Buy the leader in every industry. JB Hi-Fi is so exposed to the consumer electronics space. It was winning share, was doing well even before COVID started. The COVID, of course, people were staying at home and setting up the home office, spent a lot of money on JB. So now that everyone think, next year, how are they going to comp this? Compare the earnings next year. But you know what? This Christmas is going to be amazing for this business. People still have a lot of money. They got their jobs. Housing market is doing well. Our economy looks like it's doing better. I actually think JB Hi-Fi is going to have a pretty good Christmas in the next 12 months.
Okay, let's move to a company that's been big in the news, Macquarie linked, Nuix, or Nukes, whatever. What do you think of this company?
Oh, I love that company. Clearly.
When she loves a company, she loves a company.
I love that company. That is a company you want to stay in. Do not take profits.
Is this like another Afterpay in that sense?
It's
different business, but we'll have the popular
Yeah, it will have a lot of support. And what's amazing about this company, actually, it's been around for quite some time, and it has one of those biggest, most widest range of government contracts. It operates in that security, the data space.
It's at a time when security data is really important.
That's right.
Yeah.
There's a lot of big government contract. It certainly gives that credibility that this company deserves. And the earnings growth, of course, is not as high as Afterpay, but Afterpay is different. Afterpay is still establishing its market to see where it can go. This company actually got a solid contract and already signed those contracts for the last 10 years. And it's just been incredible and growing more and more through every one of those contracts. They involved with some of those most popularized or highly talked about stories, security stories or investigations that the company's heavily involved in. So it is a real business. It's growing at about mid-teen digits. Yes, it's expensive, it's tech, but it's got very, very secure earnings, and it's highly regarded across that security space. So I think that the growth is phenomenal for this business.
Now, you've already mentioned you like Afterpay. What's your view on Zip?
Oh, I like Zip. Interestingly, we have seen Zip struggled relative to Afterpay. I think this is a reflection of what's happening in the small cap versus a large cap. Because if you look at the large cap tech, they have outperformed small cap tech meaningfully in the last month or so. Though they were the first one to get sold off when the rotation from growth to value happened, but now they got picked up really quickly. Look at Xero, look at Afterpay. Afterpay's over $100 now again. So
yeah, 106 today.
Yeah, and whereas Xero is getting sold off earlier. I think the momentum is very strong for buy now, pay later space. I think the next update is going to be very, very strong right now because small cap managers are selling off taking some of profit in those names, are buying the resources. Maybe it's the mineral resources and the others because resources are generally a little bit underheld across the small cap managers. So this is what's happening. But come January and February, when the earning comes around, this business will outperform.
So you're saying to our audience, there's a subtext here, and a company like Zip, and probably Tyro as well, because Tyro is a small cap tech, but it's getting bigger all the time. You think they're buying opportunities at the moment?
Oh, absolutely. Tyro is, I don't want to use the word no-brainer, but it's
you have.
Yeah, that's right. Yeah. Look, I think Tyro is a great buy at this point. Share price being sold off a little bit unfairly, not on the fundamental basis, and not because of its earnings.
Because you said earlier to me when we started that the actual improvement in the business
is phenomenal.
They get weekly data.
That's right. Yeah. So you can actually, after Victoria come out of lockdown, so now the growth is now above 20% again, from negative 40% to now plus 20% year on year. So companies back into this growth trajectory caught up really quickly. So it is not only a tech, it is also a reopening stock. So but the share price struggled. Why is that? Because everyone was expecting it to be included at ASX 200, and the announcement came through last week. It didn't. So we are very comfortable in March. It will, but that is just something technical.
Okay, and we should explain to our viewers the ASX 200 index is not fixed. Some companies that lose favour because of their market cap drop out, and others because they're growing get put in.
That's right.
Now, when people like you, money hungry fund managers, but nice ones, think a company's going to go into the ASX, you guys buy them on the idea that this is going to be a buying opportunity, because some people have to buy the ASX 200 if you're running an exchange traded fund and have to have the top 200. But if the ASX surprises you and says, well, we're not including them now,
whoops, I
some
bought all
people
these
sell them
funds.
off.
That's right. This is especially true for the passive managers. These days, there's a lot of managers that manage passive money. That means it's the money that just track the index. So if index has this many stocks, they've got to include them. So the buying in anticipation means that share price, when it doesn't happen, the share price, they have to sell it. And the Tyro is not an overly liquid stock, so when they do sell it, share price will fall. And this is what's happening now, and that is the buying opportunity.
Yeah. So you're thinking the next time the ASX will review the top 200 companies, you think Tyro will get in there then?
Absolutely, you'll get in.
Okay. And I guess the growth that you're talking about will vindicate the fact that it should be in there.
Share price will be a whole lot higher by then as well. So it's absolutely will be the one
Okay,
that's weighing
she's
on.
very confident, isn't she? BWX, what do you think of this company?
BWX, I followed it over the years. It's the key brand is the Sukin brand. The cheap
Sukin brand?
Sukin brand.
Yeah.
Yeah, it's the natural skincare product that is priced at the lower price point.
Yep.
And then they sold through the pharmacies or the price line, and then they managed to gain shelf space across the supermarket.
Yeah.
So it's been doing very well. Look, it went through its patches. Was going to China, wasn't doing well. And then went to UK, was a bit slow, went through management changes, but now seems like it's back on track and that it's growing again. But one of my biggest concern for this stock is always you kind of, once one brand just not going to make you, especially in that sort of skincare space, you do need to have a few more brands. So I do want to, for me, it's probably a hold. I do need to see them to, whether they acquire more businesses or, just have more range.
But it's not a stock that you think is going to fly high compared to the ones we've mentioned. So.
It's pretty expensive. It's done very well during the COVID period.
Yeah.
So I do think there's value elsewhere.
It's a bit like McPherson. McPherson was doing very well during the COVID, but of course they've had a problem with their CEO and the share price was clobbered.
That's right. So some of the businesses, so in the COVID that you can see there's a COVID winner, COVID loser, and then there's a structural winner, structural loser. And McPherson was one of those COVID winners, but there was not a structural winner. So there's a pull forward of a lot of purchase of their products in the supermarket because there was a huge amount of traffic through the super, or not
I think
online.
even their cooking products did very well.
That's right. They all did really well. But now that the people can go back to the restaurants and that sort of demand sort of drops off. And McPherson is always kind of company with lower brand power company. So when people don't go through the aisles and see your products, people are just not going to go out and buy it. So weak business model will show through. And right now it's clearly going through a bit of patch. And next 12 months is going to be pretty tough.
Okay, final one, Northern Minerals. What do you think about Northern Minerals?
Yeah, look.
Because you're talking about small cap managers getting into resource stocks. Is Northern Minerals one on your radar screen or?
Look, I think that one is still a little bit far off at this point. I can tell you what are some of the things that the managers are looking into in the small cap space, especially. Right now, what's really interesting is the iron ore. Clearly, iron ore price pushing higher and higher. It's quite a crowded position, so people are buying those things. There's copper that people are going into. There's lithium is the interesting space that people are going into. Now, lithium is a little bit of a dangerous space because the people have lost a lot of money over the last few years.
Skyrockets the next.
That's right, and crashes. So you've got to be mindful because all of them have done very, very well. But the news flow so far is looking pretty strong, and with Tesla going higher and higher, certainly puts a lot of demand on those lower, those lithium producers and technology space.
Yeah, okay. Now, while we're here, because you do like the idea of buying quality companies when the market gets a bit silly. And I wrote for the Switzer report today that I thought Treasury Wine Estates and A2 Milk are good quality companies that seem to be affected by the current silliness of the market. China versus Australia, trade relations and all those sorts of things. Lack of Chinese tourists for A2 Milk. Am I right or wrong in saying that these are companies worth buying and holding for the future?
Absolutely. Look, I think
absolutely wrong or absolutely
right? Absolutely right. No, this is absolutely right. People get so fixated with the short-term panic, short-term uncertainty. That's why equity market is great because it creates opportunity.
Yes.
So everyone's scared of what's going to happen to Treasury Wine and the like. Share price is at just over $9. It would have been $20 if it wasn't this for the tariff. So people ask me, does a trade war has to resolve for you to buy this thing? No, because sitting at $9, 70% of or 60% of $9 is those premium penfold that is sitting in the finished goods sitting in the cellar.
Yeah.
So you're not paying for the company as much. You're not paying that much for the company. It's not going to stay cheap for long for a premium brand like that. So for us, the downside is very limited. And if the trade war gets resolved, which is not our base case scenario, share price will rally hard. So next 12 months, I think it will present a lot of opportunities opportunity for these businesses, and I think share price will recover.
Jun Bei Liu, thanks for your contribution this year.
Thank you very much.
We'll see you in the new year.
Absolutely.
And she's from Tribeca Investment Partners, the Alpha Plus Fund.
That's right.
Got it right,
Thank
didn't
you.
I? After all this time. It's
That's
amazing
right.
how I can remember something.
Thank you so much. Yeah, have a great Christmas.
Okay.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Because you're a chartered accountant, and gee, you don't look like one, you look like a normal person at this point in time, Richard. Well done, you. When your share price was around the 30s, inexplicably the market went against you and you dropped down to the low 20s, and now you're ripped into the 40s. I must admit, I haven't checked you lately. Where are you nowadays?
I think we're about $48 today.
Yes, I thought around 50. So my question is, and I know this is not your job to explain what the share price might do, but you've done it before, you defied your critics, and you've grown the business. What's going to be the big strategy going forward so we eventually see it? Well, let me pick a price, not you, $60. What's going to be JB Hi-Fi's innovative strategy going forward?
So, I mean, you and I could get lost in price to earnings ratios. I guess if you just focus on how do I grow the profitability of the business over the medium term, and we assume the rest takes care of itself.
Yeah.
If I think about that, it is one, we absolutely have to do everything in the eye of the customer. Right. And so we can't, but that can't be a blank check. So we do have it, while we want to delight customers every day, we need to do that in a financially sensible way. So we work hard with suppliers to make sure that we've got great promotions. We spend a lot less on advertising than most of our competitors, which means we can make sure our prices stay low. But fundamentally, and one of the things I'm really proud of is we actually have a pretty relatively generous internal reward program for the staff. And I think that means we retain the A team for our customers because they want to be served by knowledgeable people. And so if we're very focused, look after your staff, they'll look after your customers, and that'll look after your shareholders.
What's the future of retail? Obviously, things are changing as a consequence of the coronavirus. It's probably sped up a lot of changes. What's going to happen to retail, shopping centres and stuff like that? What do you think is going to happen, Richard?
Well, I certainly think that, we've got a lot of partners that are shopping centres that are very important to us. So I want to be sort of careful how I say this.
Yeah.
The harsh reality is some of the rents in shopping centres are hard for retailers to sustain, and it'll be interesting to see how that plays out. I'll leave others to judge it, but I certainly think for a lot of smaller retailers, those rents are not particularly sustainable. For us, I think as a mini major, we obviously attract a lot of traffic to a shopping centre, so we get a reasonably competitive rent. But I don't think most retailers at the moment think they'll have more stores in the future. Now, the argument for us is, do you have less bigger stores? Do you have less smaller stores? Or do you say, I can get more infill stores? But the reality is, I'm absolutely convinced JB and the good guys across Australia will have circa 300 stores. Because they enable so many things. They not just customers. How have we delighted customers during a pandemic? Because we have 300 warehouses across the country that we can deliver from, and are within about 11 kilometres of most customers. Whereas if we had one warehouse in Melbourne and one warehouse in Sydney, it's just harder. I'm not saying it's wrong, it's just harder.